Hello and welcome to Technical Analysis 101, where we look at indicators that market analysts and traders use to break down and analyse their financial charts. Once again, we are joined by our senior market analyst, Daniela Hathorn, who will be talking me through some of the tools that can help you in your technical analysis. On our last episode, we learned about moving averages. If you want to watch that after this, then click the link in the description. Today, we're going to be talking about the Relative Strength Index, or the RSI. So let's dive straight in. Daniela, what is the RSI?
Yeah, so as I said, we started pretty simple with the moving averages. We're taking it a little bit further now, and we're going to be looking at the RSI. I'm going to read you the definition of what the RSI is, because I'm not very good at memorizing the things, but essentially, it's a momentum indicator used in technical analysis that measures the speed and magnitude of a security's recent price changes to evaluate oversold and undervalued conditions in the price of that security.
Okay, so what does that actually mean?
Exactly, that doesn't make any sense. So essentially, what it's trying to do is trying to measure the momentum within an asset and determine whether it's overvalued or undervalued. So whether it's oversold or overbought. Essentially what it does is it compares the momentum within the price trend going up to the momentum within a price trend going down. So when the asset's been bought and when the asset's been sold, it compares those two momentums of that, the strength of that change, and essentially it gives you this oscillator. So it's set between two ranges, and it oscillates between those values, and you're supposed to read whether it's overbought or oversold. That is essentially what it is.
Okay, cool. It sounds like I need to see it on a chart. So should we dive straight in and you can kind of show me how you would use it?
Yep, we can. So this is the RSI, essentially. Okay. This is it down here. I said it's an oscillator, so it's comprised between certain values. The standard values are 30 and 70. And essentially, the basic reading of it is when the price is nearing the 30, which is the lower range, it's coming to an area of oversold. So we've seen a bearish momentum that's been continuing, and essentially you're going to expect a price reversal to the upside at some point. And the opposite with the 70, if it gets close to 70, essentially it's overbought and you're expecting it to reverse to the downside. That is the most basic reading of it. You can also customize it as well. So if you see that an asset is continuously breaking the 70 mark, for example, then you can widen the band to 2080 to adapt to the volatility of that specific asset. So you can always adapt these indicators. And the typical time period for this line is 14 days, but you can adapt that as well. So essentially, when you're looking at this, you're looking at how close is this line to the top, bottom, or even the midline of the range. If it's nearing the top, as I said, the asset is getting close to being overbought. Usually we've seen that during an extended period of bullish momentum. If it's getting close to the bottom, it's essentially getting oversold, and therefore you could expect a reverse. Now, one of the interesting ways to use it, and I think it's very helpful in markets, is it's called the RSI Divergence.
Yeah. And
essentially it's when the RSI is giving you a different picture than what price is. So let's do this visually, for example. So in a RSI, for example, a bearish divergence, okay, you've actually got lower highs happening on the RSI while you still have higher highs on the price chart. So here you can see these lines here. This is the high in the RSI here on the 13th of April, which corresponds to this high here. Then you've got a lower high here on the 24th of April, but you can see that that high is still higher on the price chart. Go to the next high here. You've got the 3rd of May. That is even higher than the previous two. So the RSI is telling us that the momentum is turning downwards, but the price isn't yet. So price essentially will need to catch up. So this is called a bearish divergence. And usually when you have this downward sloping line on the RSI highs and upward sloping on the price highs, you're expecting a bearish reversal to happen, which you can see followed on here, as you can see that reverse to the downside. The opposite happens with a bullish divergence. And here, instead of looking at the highs, you're looking at the lows. So for example, here on the 29th of May, this is a shorter one, so it might be harder to see. But on the 29th of May, you had a low here, and then followed by a higher low on the 31st of May. If you're looking at the price, we had the opposite. We had the low on the 29th of May, followed by a lower low on the 31st of May. So same thing. The RSI was telling us this momentum is changing. We're kind of getting rid of that that oversold condition. So we're turning upside. Price hasn't yet caught onto that, as you can see, and then we reverse to the upside. So that is a very good way to use the RSI, is this divergence and how it relates to price.
Okay, and in terms of the kind of the top line and the bottom line, you mentioned, is that something that you as a trader would put in, and that's your kind of time frame?
So this is the standard one. So when you click on any chart, you just put RSI, and it comes with the standard format. As I said, 14 periods, 70 and 30 are the ranges.
Yeah.
So essentially, you just have it next to the price chart, and it starts to tell you. You can look at it in isolation. So as I said, is it oversold? Is it overbought? Based on that 70-30 range, is it nearing the 50 line? Has it been hovering like the midline, which is the 50 line? Does that mean that we're seeing some sideways consolidation, a little bit of lack of momentum? So you can read it in isolation, or you can read it, as I said, with the price and how it relates to price. You know, we've got a divergence going on, or it's moving in the same direction. Therefore it strengthens the bullish or bearish trend. So you just put it on the chart and it automatically comes here at the bottom and it compares to the price.
And what sort of style of trading is this kind of really helpful for? Is it, is it day trading? Is it longer term positions? What style of trading is it used for?
I think it's an indicator that's quite broad. You can adapt it pretty much to any style of trading. I think it is quite a technical one. I know we looked at moving averages and you said you can adapt them in short term or longer term moving averages. But I think the RSI potentially, as it's an oscillator and it tries to measure momentum, I think it can be used in short-term trading as well. So again, all of these are very customizable, but I think especially if you're looking for divergence, I think you can look at short-term trading with it, because it will start to show potentially a change in the momentum in the RSI that hasn't yet happened in price. So I think that can be quite short-term and used in day trading as well.
So like with the kind of moving averages, that was more of a kind of lag of data. Whereas this, is it kind of more looking at data going forwards?
No, it's also lagged.
Okay.
A lot of the technical indicators, because they use prior price data, there's always going to be a certain lag to it, but some of them react quicker than others.
Yeah.
And the same thing, the RSI takes by standard the 14-day period. You can make that shorter if you want to make it more sensitive and reactive to the most recent price data. It's still lag, but it's the way you read it. It's different. And moving averages were giving us an average of the price. The RSI is giving us an oscillator. It's giving us momentum. It's how does the strength of the uptrend compare to the strength of the downtrend? So you read it a little bit different.
Okay, interesting. And is this a staple indicator that you would use? Is this something that every trader would use, from beginners to kind of expert traders?
Yeah, I think the RSI is, with the moving averages and also the MACD, I think is one of the standard ones. It's, again, quite simple to read, as you can see, especially once you've mastered it a little bit, you quickly pick up on the cues it's telling you. It's very easy to have on the chart. It's usually just there at the bottom, as you can see. Doesn't really take up too much space, and it's quite simple to read, and you can have moving averages on top of it, and it can either strengthen or weaken a theory that you may have already formed with moving averages. So yeah, I'd say it's good for beginners, experienced traders as well.
So yeah, somebody who's not too experienced with kind of technical trading, I would look at this and I would say, this looks easy. As soon as it hits the top, I would know that there's potentially a bearish move coming and I would look to sell. Is it as simple as, as soon as it hits the bottom, okay, it's going to be bullish now, I'll look to buy? Is it as simple as that?
Yeah. So this eventually takes us to the drawbacks of the RSI, and there's essentially two key ones. One of them is that it gives false signals, and sometimes it gives more false signals than it gives you actually price reversals. So it's something to watch out for. And look, in hindsight, everything's easy, right? Once you've got it on the chart and you see it drawn, you're like, oh, that's very easy. As soon as I see, 3 spikes going down versus 3 spikes going up, that's, my time to sell. It's not as easy as that, and sometimes you can have a divergence starting and then it corrects itself, and it's not always very easy to see as the data is developing, at the moment. So it does give a lot of false signals, so that is something to keep an eye out. Obviously, the lag data we've already said. And the other key one is that it doesn't work very well during a strong trend. And what I mean by that is, for example, if you've got a strong bullish trend that's been happening, I don't know if we can see one right now on the chart, but it happens with stocks, for example, a lot more than currency pairs. When you've got a very strong bullish period in stocks, it can get to a point where the RSI is in the overbought region and even pushing above that 70 bound for an extended period of time. And you're like, well, I mean, surely the chart's telling me, you know, we're overbought, we're overbought. But sometimes it gives you those false signals, and it's hard to read during very strong uptrends or downtrends. So what I mean by that is it can stay oversold or overbought for a long period of time before it actually reverses, and that's something to watch out for.
Okay.
So generally, because it's an oscillator, it works better during times of rapid moves to the upside and downside. So a bullish trend followed by a correction followed by a bullish trend, so then you've got that chart really moving. As soon as you have a clear uptrend or a clear downtrend of continued higher highs and higher lows, or the other way around, it starts to weaken a little bit because it stays in that oversold or overbought region for longer than you would expect, and therefore you kind of start to get a little bit wary of, you know, when is it going to tell me that momentum is reversing.
Well, thank you for that, Danny.
My pleasure.
I think RSI has finally clicked in my head. And thank you for watching. Don't forget to like and subscribe, and join us next week.